Okay, let's dive into this. Welcome to today's Explainer, where we're going to look at the absolute bedrock of long-term success in the cryptocurrency markets. We are breaking down a framework straight from the crypto trader methodology, specifically looking at day 27, which is all about the creation of a professional trading journal. Now look, I know what you might be thinking. A journal? That sounds like homework, or honestly, maybe you just rather stare at Dogecoin memes all day. But this isn't about writing down your feelings. It's about building an airtight system. We're going to unpack the 12 essential pillars that literally separate the amateurs who rely on pure luck from the seasoned professionals who rely on hard data.
So here is our roadmap for the explainer. We'll start by defining the professional edge, and then we'll progress from logging raw essential trade data into building out actual mechanics and strategy. After covering how to manage your risk, we're going to dive deep into the inner game of trading psychology, all to extract that final ultimate lesson.
Section 1. The professional edge. Let's talk about moving away from amateur, emotion-driven trading and stepping into a truly disciplined approach. This right here is where we completely shift our mindset. You see, the transition from being an amateur, emotion-driven trader to a disciplined pro, it doesn't actually happen by just staring at charts all day. It happens after the trade is already over. It happens in the review process. This 12-column framework is about to become your new best friend. Now, I want you to frame this blank journal not as some sort of diary, but as a clinical autopsy of a trade. It gives you a bird's-eye view of every single required element. If you take a trade and you can't fill out every single one of these 12 columns, date, pair, setup, entry, stop, target, risk, result, screenshot, psychology, mistake, and lesson, well, you weren't really trading, you were just gambling. So let's break these columns down piece by piece. Section 2. Essential trade data. Let's move briskly into the objective facts that form the foundation of our hypothetical crypto trade micro-narrative. Because every story has a setting and a subject, right? So the first two pillars are the date and the pair. Think of this as the basic identification phase of our trade autopsy. We need a precise time of death, or, in a winning case, a time of victory. That's your date. This timestamp of execution is absolutely vital because crypto markets move in very distinct cycles. A strategy that works brilliantly on a Tuesday morning might completely fall apart on a Sunday night. And then, of course, we need our subject, the pair. Are you trading Bitcoin against the US dollar, Ethereum against Bitcoin? Logging this objectively roots your entire trade in reality, long before the emotions can take over. Section 3, Mechanics and Strategy. Now, what's really interesting about this slide is seeing how that raw data actually becomes strategy. So, we begin to see the objective facts transform into calculated moves. Pillar 3 is the setup. The setup establishes the strategic why behind your hypothetical trade. Seriously, why are you clicking that button? This has to be clearly defined before a single cent is put on the line. Are you looking at a breakout from a consolidation pattern? Is it a quick reaction to a major news event? By forcing yourself to articulate the specific market conditions and technical triggers right here in this column, you completely eliminate the "I just had a gut feeling" excuse. Moving to pillar 4, we have the entry. This is the definitive moment of commitment in our trade narrative. It's the exact numerical price point where you officially stepped into the arena. Let's say exactly $60,000 for Bitcoin. Documenting your entry price allows you to look back later and evaluate. Were you way too eager and bought in too high? Or did you patiently wait for that perfect pullback? And then we have the target. This represents the absolute best case scenario of the trade. It illustrates your planned successful outcome. You see, a professional trader never, ever enters a position without knowing exactly where they plan to take their profits. Because if you don't have a target written down in your journal beforehand, greed will inevitably take over, and you'll end up writing a winning trade all the way back down to a painful loss. Section 4, Managing the Risk. So the crucial point is protecting your capital is your most vital survival skill. We've talked about the best case scenario, but hey, the market doesn't always agree with us, right? This brings us to the stop or the stop loss. Clinically defined, this is your emergency exit price level. It's set to automatically close a losing trade and prevent a minor scrape from becoming a fatal wound to your portfolio. And listen, this pre-planned exit is completely non-negotiable for professional survival. Having this filled out in their journal proves that you accepted the reality that you might just be wrong, and you proactively planned for it. Paired directly with your stop is your risk. This is the quantifiable maximum amount of capital you are willing to lose if the trade actually hits that emergency exit. Professionals calculate their exact financial exposure before they ever enter the market. By writing down, I am risking exactly $100 on this trade, you take the fear entirely out of the equation. Why? Because you've already accepted the worst case scenario. And this brilliantly illustrates the duality of trading. On the left side here, we have the math, the entry, stop, target, and risk. It's cold, it's clinical, and it's perfectly objective. But on the right side, we have the mind, the psychology, the mistake, and the lesson. This is exactly where we transition from cold numbers into the messy, human reality of dealing with fear, greed, and uncertainty. Section 5, the inner game. Let's move to and see how this builds directly into internal reflection.
So, welcome to the subjective side of the journal, and honestly, this is where the real growth happens. The postmortem process flows through these 4 specific steps. Step 1, log the result. Was it a win, a loss, or just a break even? Step 2, attach the screenshot. Now, this is absolutely vital. A screenshot of the chart at the exact moment you entered and exited serves as visual, undeniable evidence for your psychological analysis later. It prevents your own memory from playing tricks on you. Then, step 3, analyze the mistake. And finally, step 4, extract the lesson. Let's take a closer look at how those last columns actually work in practice.
To properly fill out the psychology column, you need brutal honesty. You might write something like, I held on too long out of pure greed, ignoring my own target. When you write this down, you are literally holding a mirror up to your own flaws. The market didn't take your money, your own greed did. Ouch, right? But the journal is the only place where you can safely and objectively confront that reality. Which leads us directly into the mistake column. Now, a mistake here isn't just losing money. Actually, you can execute a perfect, flawless trade and still lose money if the market suddenly turns. No, a mistake is defined as a deviation from your planned setup, your strategy, or your risk parameters. It's an error driven by emotional impulse. So I strongly urge you to use this column to frankly identify exactly where your discipline broke down during the trade. Did you move your stop loss because you were scared? Did you enter way too early out of FOMO? Log it, own it. Section 6, the ultimate lesson. We have finally arrived at the final and really the most profound step of our data to wisdom narrative arc. Every single column we filled out so far has simply been preparation for the 12th and final pillar, the lesson. This is where you transform a single, isolated trade, whether it was a win or a huge loss, into a hardened, permanent rule for your future self. It is the permanent wisdom extracted from temporary market chaos. When you look back at your journal after a month, you shouldn't just see a boring ledger of profits and losses. You should see a highly customized textbook written by you for you, detailing exactly how to master your specific trading style. So as we wrap up this explainer, I want to leave you with a real challenge. Stop trading blindly, stop letting your wins artificially inflate your ego, and stop letting your losses completely shatter your confidence without even understanding why they happened. Implement these 12 pillars today. Treat every single trade as a clinical, journaled autopsy, and ask yourself right now, what will your next trading lesson be? Thanks so much for joining me on this explainer, and I'll catch you